Folks, talk about Canadians buying U.S. real estate. My name is Rob Lamontagne, and around the Thrive community, you guys all know me by now. And we'll start with a little bit of a legal disclaimer, because we are going to be talking today about legal components, about tax components, about accounting. So understand that proper advice is important. We're not lawyers, accountants, tax advisors, tax planners, any of those things. We are just real estate investors like you. And what we do here is share experiences with you and our thoughts based on our experiences. Our experience may or may not be appropriate for you. So it's important that you make sure that you consult the proper professionals and get the proper advice for you. So to start with, a little bit about how I got involved in U.S. real estate. As you guys are aware, I started out following the Rich Dad program in Canada. And after about a year of that, I started looking south of the border as well. And I took a couple of courses in short order on U.S. real estate, one with Glenn Purdy of the Millionaire Mentor Group, and the other one was Steve Martell dealing with U.S. foreclosures. I followed it up and did both Rich Dad courses in the U.S. under Rick Mariansky and Larry Schooler. They each have different take on financing in the U.S. I also did a U.S. tax and assessment and asset protection course with Anderson Business Partners in the U.S. so that I could understand asset protection and tax planning. I did commercial real estate with Terry Hale, and I also did a self-storage course under the Scott Myers program. So before venturing into the States, I started out with some courses and have continued along the way to have a basis for, number one, doing what I'm doing and talking about what I'm doing. So it's fair to say that property prices in Canada have increased way faster than the increase in rents, especially in provinces like Ontario, BC, Quebec. We have places where there are fairly stringent rent controls and rents have been restricted. So even though rents have gone up, the increase in rents for existing tenants have been highly restricted, and yet property values continue to increase. So it's becoming harder and harder and harder to find those properties that are going to cash flow positive. So what can we do? Well, when I started looking, I found that the answer was actually south of the 49th parallel. And what I found out was a tax law called the 1031 exchange. And it really is. It's a powerful and creative way to finance down payments. So 1031 exchange is actually a section of the U.S. tax code. And what it deals with is the exchange of like-kind qualified assets, where the acquired asset has a greater value than the relinquished asset. So those are the three key words: exchange, like-kind, and qualified. Now, what the Act says is that no gain or loss shall be recognized on the exchange of assets held for productive use in a trade or business or for investment. And what it does is it allows you to carry your adjusted cost base forward from one asset to the next on a disposition, as long as you meet certain criteria and you are exchanging the asset for something that is like kind. It's a case of, instead of being deemed a sale and disposition, it's being deemed an exchange. So like kind is an important concept here. Okay, the two assets must be of the same type, but not necessarily the same quality. And the rules around this get pretty hilarious sometimes. So 2 ES properties would be like kind, even if one was vacant land and another was multifamily. It doesn't matter whether the property is improved or what it's been improved with. Okay, property is generally considered like kind. That said, it only applies to a U.S. property. A U.S. property is not considered like kind to a foreign or non-U.S. property. And you have to read the fine print, because 2 cows are considered like kind, but a cow and a bull are not. So in this case, the gender of the animal determined that it was not like kind. So like kind applies generally to similar items, but not necessarily exact. And in our case, where it becomes very interesting is when we start talking about like kinds of properties. So certain assets you cannot do a 1031 exchange on, and those are properties for sale, inventories, securities, stocks or bonds, interest in partnership, or certificates of trust. So, for example, your stock portfolio, if you were to sell AT&T, you could not buy another telecommunications company and defer the capital gain. It does not work for stocks and bonds and securities. But the nice thing is generally speaking, if an asset is not specifically excluded, it is considered qualified. So you don't have to go too far when it comes to looking at the type of investment that's acceptable. You just have to know whether or not it's actually specifically excluded. And there's some key conditions that have to be met. The value of the replacement asset must be equal to or greater than the value of the relinquished asset. So we have to be upgrading. We have to be buying something that is more expensive. The equity in the replacement asset must be equal to or greater than the equity in the relinquished asset. We have to carry all of our equity forward into the new asset. If we take any out, then we don't qualify for 1031 exchange. And lastly, the debt on the replacement asset must be equal to or greater than the debt on the relinquished asset. So we have to be buying a bigger asset with at least the same equity and a bigger mortgage. And the biggest key of them all, in all summary, is that all of the net proceeds of the exchange of the relinquished asset must be used to acquire the replacement asset. Okay, you cannot turn around and sell a property and take $50,000 out for personal use or for other use. You have to carry all of the equity forward. And there are specific time limits to this. Okay, so a taxpayer has 45 days after the transfer of the relinquished asset to properly identify a replacement asset. This is why you are going to see on a lot of US listings, okay, that a 1031 exchange is pending. They will get to a point where they're close to selling their property or they're looking to sell their property. But prior to doing that, they're already looking for an asset that they're going to be replacing it with because they only have 45 days to identify the asset at the time that their property for sale is closing. And the second time condition is that the exchange has to be completed on the earlier of 180 days after the transfer or the taxpayer's federal return due date. So for most taxpayers in the US, taxes are due on April 15th. So what you're going to see is as you get closer and closer to the tax return due date in the US, you're going to have fewer and fewer 1031 exchanges. And you're going to see the bulk of them, okay, start to occur after April 15th and into the summer. If the time limits are not met, the exchange fails and the transaction will be deemed a sale. And the taxpayer will have to pay the capital gains tax. The IRS makes very, very, very few exceptions on this. So you have to make sure that you adhere to the time limits. Unfortunately, we don't have this in Canada. We are not allowed to defer the capital gain on a property that we acquire based on selling one and replacing it with a different asset. And it applies to real estate. So this is one of those areas where the differences between Canada and US real estate laws is advantageous if you're able to buy in the US. And I'm Canadian. So that became a problem. How am I going to fix this? So the bad news is CRA does not recognize the 1031 exchange. Okay. If you sell something and exchange it under a 1031 exchange, it is considered a capital disposition and you are taxed in Canada. That is just the way our legislation works. We do not recognize it. And because no US tax was paid at the time of the exchange, there's no foreign tax credit and the entire tax is owed in Canada. That means double taxation when you come time to sell in the US. So it's a very difficult tool to use or difficult strategy to use as a Canadian if you don't know what you're doing. But here's the good news. It can be done. Okay. But you cannot hold the US capital assets directly. The capital gain on the disposition does not flow up to Canada. It's important. In order to do this, a US corporate structure has to be created and must be added to your Canadian corporate structure or to you personally. So here's an example using one of the three-tier corporate structures that we use in Canada, where we have a holding company, we have a management company, and then we have real estate companies that hold the asset. Now, most people dealing with US real estate will tell you that you buy your US company in an LLC, and you'll either hold it personally or it'll be connected to your Canadian company. The problem with this is that an US LLC is a flow-through entity. Whatever happens in that entity flows through to its owner. And this is where, if you sell it in the States, you can take advantage of a US capital gain if you're a US citizen. But in Canada, because we don't recognize the 1031 exchange, the sale flows through either to the person or the corporation that owns the US LLC. What you have to do is create a US C Corp between your Canadian entity or yourself and the US LLC. Now, just like in Canada, a corp is a separate legal entity. And so a corporation is taxed on its own, and the owner of the corporation is not deemed to have direct access to the assets. So as such, if you have that C Corp there, just like in Canada, the business activity of the LLC will flow to the C Corp, and the corporation will then be liable for the tax. But the owner of the corporation is not. And that's how you prevent the sale of the property from flowing through to Canada until such times as you actually bring the income into Canada. So how do we do this? Well, the key is you investigate U.S. jurisdictions with no state tax, okay, and minimal business fees. And when I was looking, Alaska, Florida, Nevada, South Dakota, Texas, Wyoming, and Washington were the recommended states. And those states are still very good today. I don't know whether there are any others at this point that have been added to the list, but those are very good states. I'm set up in Nevada, and at the time, Nevada was one of the top two that were recommended. So then you find a registered agent for your C Corp and your LLC. What happens in the US is that if you are a foreigner, you are deemed to be a non-resident alien. And if you want to own a business in the States, you must have a legal representative in the States that is actually a placeholder for your corporations and your business. And this is called a registered agent. And the registered agent will deal on your behalf in terms of having a local address and be where copies of books are kept. Okay, so you set up your C Corp and your LLC in a state with minimal tax. The one caveat here is that when you're setting up the LLC, you probably want to wait until such times as you have bought a property, and you want to set an LLC up in the state where you're buying the property. I learned the hard way that being a non-resident alien does not apply as just foreigners to the US. A non-resident alien is also considered a resident of Nevada who does business in Arizona. So if you are a resident of Nevada, you are considered non-resident alien to Arizona. And as such, you need a business license in Arizona as well as the business license in Nevada. So if I were doing it over again, I would wait and set up the LLC only in the state where I bought a property. But the C Corp, it can sit wherever you want. So it can sit in a state with no tax and minimal fees. Then you get a federal EIN. That's an employer identification number. And you get it for both US companies. And an EIN is nothing different than in Canada, we have a business number. So same thing, only different. And then you open US bank accounts for US companies. Now, when you're opening your US bank accounts, it is easiest to do that if you're using a US bank with a Canadian parent. So right now, it's easy to get U.S. accounts through RBC, BMO, and TD. You can sit down in your branch office in Canada, and your account manager in Canada will become your connection to being able to open the accounts in the US. The problem there is that if you're dealing with RBC, RBC sold off their commercial division of their US company to PNC Bank. So be aware that if you are going with RBC and you're going to open a multifamily commercial account, then you're going to end up with PNC Bank. And PNC Bank will only do business with you if you're doing business with them in a state that they operate. And they're a local bank in Georgia and Florida. So just be careful with that one. And then you start investigating properties and making offers, just like you do in Canada. So it's no different than Canada in terms of making offers. And the terms and conditions that you would put in your offers are exactly the same. You're looking for financing, you're looking for inspections, you're looking for verification of income and expenses, you're looking for verification and approval by your solicitor and by your partner. Okay, these are all the same conditions that you're looking for if you're buying a US property. And then be aware that you're going to have to file US taxes for your US companies, and you may have to file US taxes for yourself and get an ITIN. An ITIN is equivalent to a social insurance number for a non-resident in the US. So in the US, they have social security number, we have social insurance number, and ITIN is the social security number for a non-resident alien. And make sure you get proper legal and accounting advice. Very, very important.